I'm Jon Forster, and welcome to this engaging video from the Society of Actuaries titled "Is Takaful Just Another Name for Mutual Insurance?" I have a great guest here today. I have Hasham Piperdy. Hasham is an expert in the field, and he's the managing director of Badri of Saudi Arabia. So I'm very excited to get his take on this subject. This is a part of a video series on Professional Development Edge Plus around Takaful, so be sure to watch the other content that's available on the platform. And it's also based off of a research paper from the Society of Actuaries Research Institute that is titled Takaful, an Alternative Approach to Insurance. How you doing today?
I'm doing great, John. It's lovely to be here.
Yeah, thanks a lot. Great to have you on. Great having an expert like you from the Saudi region to talk about this great topic. So we'll get into these questions. First off, first question is, what do Takaful and mutual insurance have in common? Let's talk about the similarities first.
That's a great question, John. Something I get asked quite a lot. In fact, there's a lot of similarities. So if we think about the principles of both Takaful and mutual insurance, so Takaful is similar. You have principles of mutual cooperation and collective risk sharing. So in mutual insurance, the policyholders essentially own the insurance company, right? So in a mutual, I pay premiums into the common pool, and any profits after claims and expenses come back to me as a policyholder, either as a dividend or a reduction in future premium, for example. Now, Takaful is very similar. So mutual collective risk pool in a shared fund. And surplus is also, if there is surplus in the fund, it's also returned to the participants in the fund, essentially the policyholders of the fund. So both models are very similar. You have the collective risk, community interest, which takes precedence over shareholder profit. So very similar in that respect.
Excellent, excellent. So yeah, they do seem pretty aligned, but let's get into some of the structural details. Who owns what in each model? Why don't you just explain that a little bit?
Sure, sure. So talked about, yeah, you have they're very similar in at one level, but once you start digging into the structural details, you do get some differences starting to come out. So I'll give a few high-level examples. So in mutual insurance, right? So who owns the company? Well, the members, the policyholders are the members. They own the fund, they own the company. So policyholders essentially provide the capital base and also assume responsibility collectively if there's any deficit rather. Sorry. In Takaful, slightly different. So the capital is actually provided by shareholders, not the participants or the policyholders, if you like, not the members. So the participants don't own the company; they own the risk fund, the participants fund. And this is a key difference because if there's a shortfall in the Takaful fund, it's actually the shareholders who have to step in and provide an interest-free loan called the Qard Hasan. So the shareholders step in, provide a loan, and the idea is in the future, when we return to surplus, the loan is repaid. So the critical distinction is, in mutuals, we as policyholders, members, we own the entity, and in Takaful, the entity is owned by the shareholders, but the risk pool belongs to or is owned by the participants. Key distinction there.
Yeah, great distinction, great information there. So what about the surplus? Who benefits when there's good performance in a Takaful plan?
Sure. So again, if I think about in both models, right? In a mutual or Takaful, the surplus can go back to the participants or members, if you like, but how it's handled is slightly different. So in mutuals, the surplus belongs to the members because we, as members, we own the mutual insurance company. So we get it back as a dividend or a reduction in our future premium. Now, in Takaful, the surplus belongs to the participants' fund, and it's redistributed only after satisfying Shari'ah conditions. So this is some examples of things like, there's adequate reserve to cover future risks, and also if there's any GARD. So if there was an outstanding loan for a deficit in the past, that has to be repaid first before any surplus can be redistributed. So similar, but slightly different in terms of how surplus is distributed.
Excellent. And then let's talk about the investment side of things. Do both models invest the pooled funds in the same way?
Not quite. Okay, so mutual insurers can invest in any market permitted assets. This will include things which are prohibited under Takaful. So things like interest-bearing securities, like treasuries, government bonds, corporate bonds. Takaful funds are restricted to Sharia compliant investments only. So the investments have to comply with Islamic principles. So no interest, so no conventional bonds as such, no interests which are associated with businesses that are involved in things like gambling, alcohol, pork, or other forbidden activities, however they may be defined. And there's a focus on Islamic investments, so things like Islamic bonds, sukuks, or hard assets like real estate. And there's also a variety of structured Islamic instruments that have been developed over the years. So um, the Takaful operator has a more restricted universe of Sharia compliant assets to invest in, if you like. And there's a Sharia supervisory board which ensures that all the investments, adhere to those criteria. And there might be other regulations from the local regulator as well. So a more limited universe, if you like, of assets.
Yeah, so let's talk about those regulations, and oversight. Do mutuals and taxable companies have some differences there in terms of the regulatory landscape?
Yeah, so in terms of oversight, so at a high level, absolutely so mutuals are governed by a board which is elected by the members, so as the members are the owners. But Takaful governance has essentially two layers. So you have a board of directors, so a typical corporate structure, board of directors appointed by the shareholders. But then you also have a Sharia supervisory board, which is independent, and they will be responsible for the second layer, the Sharia supervisory board, a group of Islamic scholars who review the business activities and the company's policies for things like investments and so on to ensure that it adheres to Sharia compliance. So this is the second layer, which is quite unique to Kaful.
Yeah, excellent. And let's get into the values. What do you think? Are both of these models ethical?
Absolutely. I'd say very similar in terms of ethics. So both models emphasize fairness, um, and there's a lot of similarities when it comes to ethical principles, especially when you don't have a traditional corporate structure where the insurance company is owned by the members. But with Takaful, there's the extra dimension. So to avoid certain prohibited financial practices. Some of them I've already mentioned on the investment side, for example, and also reinforces social responsibility. But the principles of solidarity, mutual cooperation, I see a lot of similarities with mutuals in that respect. So mutuals can be ethical in practice, but they're not bound by the second layer of the Islamic governance under Sharia. So there's this extra layer of religious accountability. So yes, ethics, but ethics in line with the religious principles as the foundation. That's the extra layer for Takaful.
Yeah, that's great. And I think we'll wrap this up. Why don't you just give us in summary a side-by-side comparison between the mutuals and Takaful plans? Just what are the high
Sure.
level side-by-side comparison of those two?
Sure. I think this is actually a really good lens to look at Takaful because, a lot of us work with, are very familiar with mutual insurers, whichever part of the world we're in. So let me take a few different dimensions. So starting with ownership. So in a Takaful, you have the shareholders and the participants fund. Um, and in a mutual, so the shareholders own the shareholders fund, and the participants only have responsible own, if you like, the participants fund, the risk fund. And in a mutual, policyholders or the members own the entire company. So there's a bit of a difference there. In terms of capital, who provides the capital? So again, this is reflective of the ownership structure, right? So Takaful, the capital is provided by the shareholders. In mutual, it's provided by the members. And then also surplus and deficits, surpluses and deficits. So in a Takaful, um, the surplus is returned to the participants after certain conditions and approvals are obtained. And in a mutual, surplus is similarly returned to the members through a dividend or a reduction in premium and so on. And normally there's a governance structure as well, similar in a similar manner. Now, the difference is with deficits. So in a Takaful, if we have, for example, the hybrid structure, if there's a deficit in the in the participants fund, then there's a Qard Hasan, an interest-free loan from the shareholders. So they step in, provide the loan, and then that loan is repaid when the fund returns the surplus. In a mutual, any deficits are borne collectively by all the members or policyholders, if you like. So slight difference there. Last 2 points, I'll cover investments and overall oversight. So in terms of investment, um, mutuals have a broader universe of investments. Takaful, the investment universe is more restrictive. So there's a second filter where investment strategy has to be in line with Islamic principles and Sharia compliant. And finally, in terms of oversight, so Takaful, um, you have a board, a conventional board, like a mutual, but you also have an independent Sharia supervisory board, which is responsible for essentially signing off on and approving the Sharia compliance of the company's policies, things like the investment strategy and so on. So I think, there's a lot of differences here and there, but both, I'd say the similarities outweigh a lot of the structural differences because both models share the principles and ideals of a cooperative. Takaful just adds an extra layer of Sharia compliance, so faith-based ethics, and you get this separation in some models. But I would say that both emphasize the spirit of cooperation and risk pooling amongst members in a very similar way. And if when actuaries move from a mutual to a Takaful, it's actually quite a simple transition because of the similarities, if you like.
Yeah, excellent. And yeah, this has been a great discussion, a lot of valuable information here. So thanks a lot for providing it. One thing I do want to remind everybody, there's a really great research report available from the SOA. It's called Takaful, an Alternative Approach to Insurance by Shari'ah Sikander. If you want to go to that report, just go to SOA.org, click on the Research Institute, then click on research by topic, choose general insurance, and then on the landing page, click on research report. You'll see at the top of the page, they'll have all the SOAs research report on general insurance. So if you just go to the report, Takaful, an alternative approach to general insurance, that was posted in April of 2024. That will bring you right to the report. So thanks for joining us, and be sure to keep checking PDH Plus for more content on Takaful or all of your actuarial needs. Thanks a lot for joining us, Hasham.
Thank you, John. It's been a real pleasure. And if any of you have any follow-up questions, feel free to reach out to me directly as well.
Excellent. Thanks for having me on.
The views and opinions expressed in Society of Actuaries podcasts are those of the speakers or authors and do not necessarily reflect the views of their employers or the SOA. The opinions expressed should not be construed as legal or professional advice and are provided for educational purposes only. Please see the terms of use on SOA.org for more information.